Today, is inflation rising from its slumber? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, new US inflation numbers came out and they have a number of signals, some of which look like reasons for concern. The headline figure deteriorated for the first time in months, rising 0.6% in the month and 3.7% year on year. The broadest picture, breaking down into food, energy and core services and goods, excluding food, tells the story. The advance in the CPI was supported by higher costs for rent, air travel, and motor vehicle insurance, which rose the most annually since 1976. New car prices rose for the first time in 5 months, and costs declined for used cars and admissions to concerts and movies. Shelter prices, which are the biggest services component and makes up about a third of the overall CPI index, increased 0.3%. That's the smallest gain since early last year, and it was dragged down by hotel stays. The cost of shelter slid a bit because the base rent rises are not yet feeding through into the overall number. They probably will later. A moderation in housing costs will be an essential feature for a sustained downtrend in core inflation. The so-called core consumer price index, which excludes food and energy costs, advanced 0.3% from July. That's marking the first acceleration since February. From a year ago, it increased 4.3% in line with estimates and marked the smallest advance in nearly 2 years. Economists favour the core gauge as a better indicator of underlying inflation than the overall CPI. That measure rose 0.6% from the prior month, the most in over a year, and reflects higher energy prices. Gasoline costs accounted for over half of the advance in the overall measure in August. But services continues to make up the vast bulk of price rises at present. Goods inflation disappeared, food inflation is declining, and disinflation in fuel is, well, reversing and reducing. That last, though, is the worrying part. But perhaps it's of no surprise the price of oil and gas is very visible. And from the point of view of the Federal Reserve and other central banks, the question is, should fluctuations in fuel change their views on monetary policy? Well, possibly it should, because of course oil and gas prices feed inflation into many other sectors of the economy. Digging into the more technical statistical measure of underlying inflation produced by different research teams within the Feds, they tend to confirm the picture that inflation is still declining, but also that it's still got a long way to go. The Cleveland Fed's trimmed mean, in which the biggest outliers in either direction are excluded, so shelter wouldn't have an impact, and the Atlanta Fed's gauge of sticky prices, which takes time to change and are unlikely to decrease, both show some convincing falls but also continue to be far above the norms of the last 2 decades. As a result, you can expect higher rates for longer. Finally, the Fed has been given prominence to a measure it's dubbed the super core services, which are driven by wage increases and thus should be susceptible to tighter monetary policy. Excluding shelter. After falling rapidly earlier this year, that measure is now stalled on a month-on-month basis, which is prone to volatility. It even ticked upward in August. But all in all, the numbers were pretty much discounted by the market and who do not expect a rise in rates when the Fed meets next week. But they are still seeing a fall next year. Louis Nevea of Nevea and Associates said there has been no change in the expectations that the Fed will not increase a week from today. If anything, the market seems to be relieved that the bonds are not trading down, as it's pretty clear that getting inflation down to the Fed's 2% target is going to be tough sledding. And after briefly visiting session highs after the data, which includes a bigger than anticipated increase in consumer prices, excluding food and energy, Treasury yields retreated to be little changed, and interest rate swaps tied to the next 2 Fed policy meetings continue to price in a chance of an increase in September, very small, and about a 50% odds of one in November. So you can see here that the question of whether the Fed can get the rate down to 2% is still a live one, and with oil prices there going higher, that could be a problem. At some point, the question will become whether the Fed will continue to stick to its 2% target or just quietly shoot for a slightly higher one. If they do, that could change things, but if they really do go for the 2% target, you have to expect rates higher for longer, and I still think inflation will be roaring back as those energy prices feed through more broadly into the economy. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.